Good afternoon, ladies and gentlemen. This is Robert Rayburn here at LifePro Asset Management, and I hope that everyone's having a fantastic week so far. We're, kind of two-thirds of the way through this particular week, and again, another interesting week in the stock market. And no week is not interesting, and that's one of the things that we just absolutely love about our job is that it doesn't matter what's happening, there's certainly something to talk about. And I think the big message really at the end of the day is we just want to stay focused, right? When it comes to investing, there's no shortage of distractions out there. When we kind of think of 2020, we had COVID, we had the election, we had the Georgia election. Then this year we had the Reddit volatility of a couple weeks ago. And one of the things that you'll recognize with us is that our message is usually fairly consistent, and that is please ignore the noise. It doesn't matter how scary it sounds unless it materially impacts the earnings to the underlying businesses that we're invested in. It's so unlikely to have any material impact on the stocks of these companies over any discernible time period past 1 or 2 weeks. If you're trying to play that short-term game, all you're doing is you're surrendering the highly valuable franchises that you own to other willing buyers that are going to ultimately reap the rewards. Don't do that. Be patient. Know that if you own good underlying brands and businesses with dominant market positions, that over time, that value should accrete to your overall account values. And so that's really how we view investing. And so, this week's message is to stop fighting yesterday's battle, right? This is something we always see is that, the media loves to run with the fear of yesterday's event, right? And then guess what? Every investor, institutional, retail, amateur, doesn't matter what it is, who they are, they all prep the portfolios for the last crisis. And the one thing we know fairly certain is that the next crisis that really impacts our portfolios will be completely different than the last crisis, right? So you can see here all the different economist covers, right after 9/11 is, how can we stop the next 9/11? And we'll really haven't had any terror attacks since 2001, knock on wood, thank God. And then of course we see a bubble warning after the 2008 crisis. This was just a year after the market bottomed. Of course, we had a decade-long bull market after that cover on The Economist. Nowhere to hide, ready for the next one, ready for the next pandemic. Guess what? We're going to be so masked up. We're going to be got sanitizer all over our faces and hands and everything that we own. That'll probably be almost impossible to get sick over the next 2 to 3 years. So, that's what humanity does. We tend to overreact, and the pendulum swings one way or the other, and that causes us to be overprepared for the last crisis and underprepared for stuff that we're not watching. And so that's our job as active investors, is we have to be mindful of what could cause the next crisis. And that's why we take a symptomatic approach to investing, because as markets weaken and become more fragile, those symptoms tend to be rather similar, regardless of what the underlying cause of the sell-off might be. So we pay attention to symptoms, not the causes. The other big thing we want to say is that, everyone's worried about inflation right now because of the money printing, because of the stimulus packages. We're not really seeing that. When we look at the data right now, it's not suggestive of a highly inflationary environment. So right now, everyone's worried about inflation and COVID, but that stock market aircraft carriers slowly turned and moved off to another direction. So what we saw over the last week is that inflation data is very suggestive that that inflation pressure remains relatively muted. In other words, inflation has actually dropped over the last month. And what's that translate into? Lower rates for longer. Lower rates for longer is good for stocks, and especially the types of companies that we're invested in. Secondly, the earnings recovery is starting to accelerate. It's not slowing down, it's actually accelerating. We'll walk through some of those charts and show everyone sort of what we're seeing in the overall market there. And then finally, that Reddit scare from 2 weeks ago, that was awesome if you're an equity investor, a real equity investor, because it took a lot of that speculative froth out of the system, took a lot of those pretend bulls out of the market, people that were dragged into the stock market kicking and screaming. Well, they got right back out. And so right now we've seen that overall investor sentiment get rather depressed again. That's what you want to see if you're in stocks. Real quick here in terms of overall performance, off to a nice start here in 2021, up 10.34% year to date as of February 9th. S&P 500 over the same time period, up 4.13%. We stretch that out to the last year. So over 1 year, we're up 105.12% versus 17.5% for the S&P 500. In other words, if you've been invested with us over the last year, we've been able to generate outperformance of 87.6% after fees. So it has paid to be with us versus a low-cost index product. Since inception, up 261.48% versus 74.7% for the S&P 500. If anyone has any questions on these performance numbers, definitely feel free to give us a call. We'll be happy to walk everyone through those numbers. So the big thing from this week is inflation and how there is not a whole lot of it. So we got the inflation report this week. It's something that when we look at the bear arguments for the overall stock market, inflation is right up there as one of their number one concerns. And it's certainly one of our concerns. But we pay attention to the data. We have a lot of things that we're concerned about. But until the data manifests itself for those concerns to be justified and impact asset allocation, we're not really going to let the fear of something that may or may not happen impact how we allocate assets. And so right now the data is actually saying inflation is falling. And if we listen to what the Federal Reserve said today, the Federal Reserve said, quite frankly, that we're going to wait for inflation to actually show up and accelerate in the real data backward looking before we even consider any moves on interest rates. So again, a very dovish statement by the Federal Reserve. Lower rates for longer, good for stocks. The concept of TINA, there is no alternative. In other words, if in a zero interest rate environment, stocks remain the most attractive asset class relative to bonds, cash, and real estate. Short term here, obviously had a lot of good short-term momentum in the stock market. Really, we've seen here over the last 7 or 8 sessions, markets have risen. We only bring this up is that because, over the next week, we could see some down days in the market. That's normal. We don't try to time those daily moves in the market, but anytime you get a short sprint, you can have a couple down days just to, for the markets to catch their breath. But overall, when we see short-term momentum backed by a long-term uptrend, in other words, more than 70% of stocks are trading above their 200-day moving average, that is a positive symptom for the stock market as it relates to forward returns over the next 6 to 12 months and beyond. So again, when we look at the symptoms of the market, both from a short-term and long-term perspective, very, very bullish when we look at historical data overall. This is a chart we've had the last few weeks, but again, over the last couple weeks, we've seen a lot of that speculation flushed out of the market, right? So when we look at the demand for investor protection in their portfolios, clients and investors were paying up for front-end protection versus long-term protection. That is usually symptomatic of panic. And that's usually symptomatic of markets that are in a short-term bottom. We talked about that a few weeks ago, and sure enough, we had that nice strong bottom off the, call it about a week and a half ago, and we've had a nice rebound ever since that time point. We also saw a lot of degrossing across hedge funds across New York, Hong Kong, Toronto, London. And what we see here is the combined value of their shorts and longs were forced to be degrossed as certain VAR metrics were hit at those funds and forcing them to raise capital. When that type of that type of action happens, that again is symptomatic of a bottom, because it's not fundamental based, it's structural based, it's risk management based. So when you do see that type of action, usually a good time to put some more money to work in the market. And so far that's played out, and you can see that in the overall performance numbers, with ourselves up over probably 7 or 8% over the last week and a half in client portfolios. The other thing we talked about was, those fake bulls that were in the market, people that were forced to invest in the stock market, kicking and screaming. Well, all of that's off. We can see here over the last couple of weeks, the whole Reddit's episode really caused sentiment to collapse. We saw that sell off very short term here in the market, and then boom, right back up to the top and through the short term range in the market, breaking out to the upside, upward, and to the right. From a short-term technical standpoint, that's something you want to see in the price action, where you get a sort of people get chopped at the knees, causes that fear to unload assets, and then that structural support, given the long-term uptrend of the market, people come in and support the market at certain support levels, and then we break out through the upside in terms of that short-term consolidation. So we can see here, this was resistance. We broke up through that on heavy volume, and we're upward and through the right. Very good from a stock market health perspective. Then again, we always look at symptoms of the market, right? So are economically sensitive assets outperforming what we call bunker assets, right? So gold, bullets, food, that kind of stuff. And the bottom line is that copper continues to outperform gold. Use copper more and more as the economy opens up and accelerates. Prime uses of copper, of course, in industrial equipment, in in things like white goods, fridges, stoves, stuff like that. A lot of copper input. So when that again is up, it's suggestive of rising construction activity, rising durable goods purchases across the board. So again, copper outperforming gold is a symptom of an improving economic environment and an improving risk environment as it relates to stocks. And we can see how bonds are continuing to be sold off as a result of 10-year yield going up. As you know, interest rates go up, bond prices come down. And that's what you want to see, generally speaking, in a controlled improved risk environment in capital markets. The other thing we wanted to talk about was how case counts are falling, regardless of the spread of new COVID mutations. I think that's very, very key. So one of the things we want to show here on the chart on the left is that US, Canada, Europe, Latin America, we've seen a dramatic decrease in the overall case count, while we see a rising tide of Americans become vaccinated. So overall, 40 million plus Americans have now received at least one dose of the COVID vaccine. So what we want to see is, as these vaccinations rise, are we seeing that actually play out in falling case counts? So far, the answer is yes, both in US, UK, and in Israel. These are the three horsemen that we want to pay attention to when we're trying to track to see whether or not the vaccine is working. Why? Because these are the three countries that have done a fantastic job at getting their citizens vaccinated. Israel being sort of the gold medal winner, UK number 2, and the US number 3, although the US is rapidly catching up to the UK as vaccinations accelerate across the board. Now, we get the other question, what about mutations, right? We've seen certain mutations of that virus, and how is that impacting case counts? Well, the mutations have been centered in three countries, the UK, Brazil, and South Africa. And the good news is that the case counts are dramatically falling in the UK. As we know, the UK has some of the highest rates of vaccinations, but also some of the highest mutation spreads. So the fact that the case count is falling in the UK is suggestive that these vaccines are effective so far. It's very early at stopping the spread of these new mutations that have been forming in the UK and now spreading across the US. Brazil, same deal, and we can see that in South Africa as well. There's the two main, the South African strain, the UK strain. Again, we're seeing falling case counts across the board. Now, can we see a rising, a third sort of a fourth wave in March? Possibly, right? Because we got spring coming in, people are outside more. We see people getting less strict with their masks and stuff like that. So that's not off the table. But I think the fact that we're at 40 million Americans, we got certainly millions of Americans that have already had the virus. I think that's suggestive, again, of where the overall impact of COVID as it relates to the economy and the market should continue to decrease. And again, going back to those covers, when is the next one? Again, very emblematic and aligns up with our data where, again, COVID is sort of yesterday's battle. Earnings season, again, right now we're seeing a historical record of any quarter in terms of the number of companies exceeding sales estimates. Again, very emblematic of the sharp return to trend prior to COVID. And that's part of the reason why you've seen the stock market generally recover, is that COVID was a punch to the face, not a long-term ailment such as cancer, right? It's not going to kill the patient. It was someone came out of nowhere, punched you in the face, and then once you recovered, you're back off to the races. That's punch to the face, recovery, back to long-term earnings trend. So again, overall, earnings are the mother's milk of stock markets and stocks, and whether or not prices go up or down. And I think the fact that we're getting back to that long-term trend is very, very positive if you're a stock market investor. Lastly, as we look at every single week, credit markets just continue to be so robust. When we look at overall credit spreads, we look at the cost of credit insurance, those risk premiums just continue to fall. And regardless of Reddit or anything else, we just saw, again, continued improvement through that time period. So at the belly of the beast of the financial system, the pipelines look healthy. Credit is going from lenders to borrowers with no blockages whatsoever. It's those blockages that cause heart attacks, financial heart attacks like we had in 2008. And we see absolutely no sign whatsoever at this point in time. So overall, the low levels of inflation and interest rates are providing structural support for equities. Think of an air mattress. Press down on one area, that air's got to flow somewhere, and it goes to the point of least resistance. That point of least resistance right now are stocks. Investor skepticism, consider that an asset for stock investors. Don't fight the earnings recovery. This is exactly what happened in 2009 and 2010. 2009 was about multiple expansion. 2010 was about the earnings recovery. We think that this year is about the earnings recovery. Stay focused on companies that can grow their earnings, and that means best of breed, long-term secular growth stocks. And that's exactly where we're invested in. And then lastly, credit markets are healthy and show no real signs of distress. So overall, if anyone has any questions, concerns, feel free to reach out to us. We're here to help. And feel free to please reach out to your advisor if you have any questions or concerns, and have a fantastic weekend. Thank you again for all your business and trust through what's been, again, a turbulent time period, but a time period where we've been able to create a lot of value for clients, and we hope to continue that going forward, and we see all the signs there are that we will be able to continue that going forward. So thanks again, and have a fantastic week.